Hi, Natasha. Hi, Geisha. Welcome. Hi, Delphin.
Hi, Benedict.
Good morning. How are
Hi,
you?
everyone.
Good day.
Hi,
Welcome
Benedict.
back.
Thank you. Thank you. I'm very happy to be back as well. It's been a while, it seems. It seems like it's been months, but I think it's only been 2 weeks or so. But I'm happy to be back and see you all again. Perfect. So we're going to take a couple of minutes just to let everyone arrive. Hi, Joanne. Welcome.
Hi, thank you.
And I think probably at around 3 or 4 past, we can jump right in. So yeah, we'll just take a couple minutes to let everyone arrive. Hello, Christoph. Welcome.
Hey, everybody.
Hi, Christoph.
We're just taking a couple minutes at the beginning to let everyone arrive within the first 5 minutes or so.
Yep, all good.
Hi, Beverly. Welcome.
Hi, but I'm not seeing anything. I may have
Yes,
to
we're
come.
about to start. We usually just leave the first 3 to 5 minutes or so to let everyone arrive in the meeting. But I think this would be a good time to jump right in. I think that we'll probably have a couple of other participants joining within the next couple minutes. So welcome, everyone. Good morning, good afternoon, good evening, wherever you are in the world, to the 7th session of the Women in Resilience Finance Mentorship Program. I'm very happy to be back with you all. I was out last week and I watched the recording. It was a very fascinating discussion. So today we will be focusing on a deep dive into digital resilience strategy development for financial institutions. We are going to have 2 mentors today that I'll be introducing further on, Christoph and Delphin, who are from YAPU Solutions, actually. So we'll be exploring conceptual, financial, and practical frameworks to strengthen climate resilience within financial institutions, and most importantly, to make it operational and easy to understand as much as possible. So a couple of the things that we will be going through is a step-by-step guide in terms of operationalizing digital resilience finance. We'll also be taking a look at a case study to integrate environmental solutions into financial decision-making. And you will also get to see a demonstration of a digital platform for enabling resilience finance. So we're pretty excited about today's session. Before we jump into the recaps that we have planned, I just want to provide the opportunity for a new participant to present herself, Beverly, who's taking over for Vanita, from Central Finance Facility. So Beverly, if you want to take maybe 2 minutes or so to introduce yourself to everyone, and then we can jump right into the recaps. Oh, I think you're muted. Here, let me see if I can unmute you. Let me see. I see that there are 2 of you in the meeting, so I'm not sure if maybe there's a glitch there. Yeah, I still can't hear you. It's interesting. I could hear you before, but I don't know if maybe something changed, or you can check on the little arrow next to the microphone if maybe that there's some kind of option to unmute yourself. No? Okay, well, why don't you there you go. I can hear you. Oh, there, now I
Yes,
can
you
hear
can
you.
hear me now?
Yes, perfect. You go ahead.
Okay, I was having some difficulty.
No problem.
Hi. So my name is Beverly Nunes. I work with the Central Finance Facility, and I have been a part of the EcoMicro program from its inception. That was the lead-in program that led us into this Women and Resilience. We have at CFF launched a loan program with 3 other credit unions. And I am just happy to get involved in this Women with Resilience and learn more about each of the other countries.
Great, thank you, Beverly. And we're very happy to have you. So with that, I think I would just jump into the recap of Oricel and Regine that unfortunately wasn't able to be presented last week. They actually pre-recorded their presentation in advance, so I would just share my screen and show the video with you. And I think I also wanted to say just like to applaud their uniqueness and I guess like different way of presenting and also providing a good example of the simplicity of creating a recording when it comes to providing the self-assessment on the reflection or the self-reflection at the end of the program. It's just basically a good example of showing that it can be quite straightforward and simple to do. So thank you, Donna. Thank you. So I'm just gonna present my screen real quick, and I can show you the recordings from the 4th session. And please just give a thumbs up if you can hear and see everything properly.
Good afternoon. This is the recap of Section 4, Green and Inclusive Microfinance, the business case for the resilience of women. The presenters will be in 2 persons, Oricel, who will have made a video that she can share with us her opinion, and also myself, Regine. Key takeaways from the section is 4 point, bridging the gender finance gap, innovative financial models, lessons from the regional and global experience, and the strengthening institution commitment. The first one is bridging the gender finance. The section have go through first a very short introduction of information before we have a good discussion on that aspect. So at the very beginning, we started with a basic definition of some of the keywords of the topic of today. And after that, we also take a look into the existing MSME's women-owned business challenges. 70% to 80% of all businesses in the Caribbean are micro enterprises, usually are sole proprietorship in informal sectors. While over 70% women need MSMEs, major constraint are to access to finance, which is amplified also with the social cultural factors. We know that there are characteristics of women need MSMEs. Mostly they are home-based, very small size. They have multiple roles in their task as a woman. Also, they are quite focused in sectors such as tourism, agriculture, and service industry, where tend to disproportionately affected by climate event. Based on the challenges that we see, there are meaning opportunities that we located. So microfinance present an important area of opportunity for green finance and specifically for incorporating gender sensitive approaches. Only recent years, the focus has shifted from mitigation to adaptation, while in the region, most FIs are not ready yet. Increasing financial inclusion to include the access to finance for the MSMEs, women-led business, is one of the opportunities that we identify based on the challenges we have now. Another topic that we have a very thorough discussion is on the innovative financial models discussion. So first we go through and identify some challenges based on our expert identification. One of the good topic is that in the region, a lot of financial institutions are locked into the commercial activities business model. And also the second challenge is within the whole region, there are only very few microfinance institutions. Most of them are commercial banking, which we have lack of variety of financial institutions in the region. Commercial banks are trying to provide microfinance, but they are not either not geared or not equipped yet into that specific area. Also, there are a lot of focus on traditional banking business model, and the climate and financial educations are not sufficient within the region. So after we have discussed about the challenges, actually throughout the whole discussion, we have identified some key factors in designing the green inclusive microfinancing products, which particularly involve creative business model. Number one is proper market research, demand assessment must be done, because there are a lot of cases that the guests have shared that there is no proper market research, or they thought that the product should be in a financial area. This is the financial product that are interested, but at the end of the day, actually they see another opportunity after getting very close to the customers. The second is create innovative financial models. There are shared examples in the section that are focusing on gender lens financial product. A few examples was given. For example, the gender social bonds from Colombia. Another sharing is a lot of financial institutions can focus on revenue-based financing concept. Number three is bundle approaching. There are discussions about integration of mobile payment solution together with and gather the payment data and supporting and enhance the credit rating process on the MSME group. The challenges is particularly with this group of person, either they are lack of collateral, but also they usually do not have a good sophisticated administration for their own business. Based on that, then most of the financial institutions will easily reject it or without considering them as potential customers in terms of financing tools. Whereas we see the technology really can come in based on behaviors, payment patterns of a person or the women-led MSME group, where we can see that this have created an opportunity to be able to, based on the data we collected, that we can have more possibility to give out or to design a green inclusive microfinancing loan. The fourth point is branded finance instruments. The discussion including they could have combined grants, public sector, private capital, or guarantees in creation of financial products. Number 5 is enhance education and in both demand and supplied area. So increase awareness of the climate risk and also improve financial education. The next part will be from Arisa, where she will share more her own opinion and also the wrap up of the last session. Thank you.
Now we'll move on to Orisel's recap. Here we go.
Well, hello, everybody. This is Orisel. I'm sorry I cannot join you today, but hopefully through technology, I can share my thoughts on the lessons from regional and global experiences and also the lessons about the strengthening institutional commitment from our last session in this Women in Resilience Finance program. So regarding lessons from regional and global experiences, this session emphasized the importance of drawing lessons from both regional and global experiences in creating gender-inclusive climate finance solutions. Some practical examples include Banco W in Colombia and the innovative approach of Soji Express in Haiti, showcasing how alternative financial products can give drive and resilience. A key takeaway was the necessity of adopting customer-centric approach in product design. Financial solutions must be tailored to the specific needs of women, especially those operating in vulnerable sectors like agriculture and small enterprises. Tools such as empathy mapping and design thinking were recommended to gain a granular understanding on the unique challenges faced by women entrepreneurs. This ensures financial products not only meet business needs, but also address emotional, social, and aspirational barriers. The discussion that was taken also underscored the critical need for alternative credit assessment models in the Caribbean. Traditional banking models that are heavily reliant on collateral and credit history often exclude women and micro entrepreneurs. Some case studies from Ethiopia and the Eastern Caribbean demonstrated how revenue-based financing and innovative risk assessment tools can improve access to finance to underserved groups. Another important aspect was the importance of strengthening institutional commitment. And this was a central theme of the session, as also the needs for financial institutions to embed gender considerations into the climate risk frameworks, to include gender considerations into the climate risk frameworks and the product design processes and policy engagement strategies. Our institutions must not only adapt to their services to the realities of climate risk, but also to ensure that these adaptations promote gender equity and inclusion. The session called for gentle collaboration between financial institutions and experts in agriculture and development organizations and regulators. And this approach, having different stakeholders, it will be very important to aligning strategies, sharing best practices, and driving systemic change. When we create synergies between these sectors, then the institutions will enhance their impact, improve financial inclusion, and build more resilient communities in the face of climate challenges. So this is my summary. We can achieve meaningful progress in gender smart climate finance, and our institutions must commit to innovate, to be customer focused, and to use approaches that include collaborations among all of us. And I think that, and from the session, we take that there is significant potential to enhance economic resilience and gender equity in the Caribbean and in other regions. So thank you very much. This is Orisel Caminero, and have a happy session today. Bye.
Okay, perfect. So that was the recap of the session that we had on gender inclusive microfinance. So thank you very much, Orisel and Regine, and also for your resourcefulness in finding a way to present when you weren't present. So thank you very much. And with that, I would hand over then to Joanne and Khadija that will be presenting the session that we had last week. We are going to use all of the hour that we need starting at 10:35 your time. So just to keep an eye on the time, just to let you know. But yeah, with that, I would hand over the virtual platform to you, Joanne and Khadija, and you can go ahead.
Can you see my screen?
Yes, we can.
Okay, no. I will leave it like that because if I do that, I can't see anybody else. Does it work?
The font is a little bit small, but I think if maybe we zoom in a little bit, or maybe if you get rid of the slides, exactly. Yeah.
Better?
Yeah, that's better.
Okay.
Thanks.
Well, I'm really happy to be back because I took a window of opportunity to go on a field trip of doing field work in Haiti. And during this field work, I was in awe to see how much it is important for us working in that sector to understand the concepts. So since I came back Monday, I didn't get to watch and read and get a lot of background information and to provide my own input. I will go ahead and do a resume of the what I read and what I understood from the video that I saw. So basically, you talked about green inclusive finance, and there are three concepts. The first concept is vulnerability, how clients and institutions are affected by the environment. The second key concept is adverse impact, how clients and institutions affect themselves, the environment. And the third concept is how can this satisfy the demand and increase revenues? That is on the financial institution side. Now, from what I understand and what I read, the Green Index 3 is a framework that is used for assessing and improving green inclusive finance. It was developed by the Green Inclusive and Climate Smart Finance Action Group. And its purpose is to help financial institutions integrate environmental strategy in their green finance performance, in establishing financial instruments and due diligence processes for the client that they're serving. So it is going to be for people in agriculture and so on. Now, what are the key concepts? And you delved into details how the institution are affected, specifically in agriculture. And if I can take back a little bit from my trip, it is very catastrophic, and it feels like really an emergency for financial institutions to get on board to address these issues, because the cost of prime material is higher, the cost of transportation is higher, and the race to get immediate return often sacrifices the climate, sacrifices the energy, the environment, and in return, within 5 to 10 years, it will be a catastrophe. You won't be able to save anything. So how does it work? The institutions assess their environmental performance, most likely like a self-assessment, like you would do for an ISO certification or an audit, or when you adopt audit standards. So you plan and you prioritize green finance strategy, and you do continuous monitoring and improvement. And most importantly, you have to collaborate with the industry so you can align with the standards for performance, environmental performance, and system and management. I forgot to say one thing at the beginning, that I would be doing this presentation in collaboration with Khadija. So the first part is myself. So Khadija, I apologize for not mentioning you. Now it's your turn. Are you ready?
That's fine. Yeah, I'm here. So I'll just share my screen.
Okay, should I close mine?
Yeah, you can stop sharing and I'll
Okay,
share
thank
what
you,
I have.
Khadija. Okay.
Thank you. Right. Can everybody see my screen?
Yep,
Not yet.
I can see us, but I can't see the presentation.
Ah,
Oh,
okay.
wait 1 second. All right. Okay,
Yep,
are you
we can see
seeing
it
it
now.
now? Okay, I'm just gonna put it on presenter mode.
Perfect.
All right. So, Joanna would have stopped off right here. So basically explaining how the Green Index 3.0 works, and the importance of the PDCA model, which is plan, do, check, and act. And that's done in collaboration with industry standards, and it's also aligned with USSEPM, which is the Universal Standards for Social and Environmental Performance Management. Now, the structure, we're continuing with that, and there were mainly 4 pillars of assessment. I'll just say GI 0, 1, 2, and 3, and we'll go into each pillar in a bit more detail. The first pillar is the environmental strategy, so that's defining and implementing a strategy. I'm just gonna pull up my notes. 1 second. Right. Are you still seeing it, or are you seeing presenter mode?
We see presenter mode, but we can still see the slide.
Okay.
No, now it's if you are on 2 screens, I think we are seeing your screen.
Yeah.
On the
Right,
left
right.
upper side should be display settings. Probably you can switch screens.
Yeah, it's blocked out, I think, because I'm sharing.
Yeah.
Okay. I'll
But
go
we see your
back.
notes. We can
Yeah.
read.
Yeah, so it's just gonna basically say it's about defining and implementing the strategy. So that's GI point 0. And that talks about setting detailed goals and a detailed mission and documenting the strategy. And then it also talks about compliance with applicable standards. The second bit of it, still GI not, is also talking about responsibilities and processes and management and monitoring, especially when we're talking about the economic aspects and the vulnerability. And then every module or every pillar is marked by quantitative indicators. So they talk about, for example, for this one, when we're talking about implementing the strategy and defining it, that indicator would be an annual budget, for example, and that's assigned to this pillar. And that's a quantitative way to measure how effective the strategy would be. Let me just swap back. All right. Next, we have the GI, no, I did 0. So yeah, point 1, GI 1 is going to be identification of the environmental risks and opportunities. And that pillar, well, sub-pillar is basically talking about evaluating risks for the clients and the institutions and identifying any specific financial challenges and environmental challenges. Then the third pillar is GI 2, which talks about management of environmental risks and opportunities. And this hones in on how we integrate the risk factors into the financial decision-making process. This pillar, well, sub-pillar also talks about developing policies to mitigate environmental risks. And then the fourth pillar within the index is the financial products and services, specifically green products and green services. And this is divided into 2 main buckets. So you have the financial products and then the non-financial products. So the financial products, that would include green loans. Let me see what else I had here. the green loans, your clean energy and efficiency loans, clean water and sanitation initiatives. It also talks about the circular economy, as well as remittance products, emergency loans, and specific types of insurance. And then the non-financial bucket would deal with training and services. So, things that aren't specific financial products and things that would raise awareness towards these kinds of issues, and partnerships, technical assistance. And 1 second, switching back. And yeah, that's basically it for us because we spoke about this. And yeah, I think I'll wrap up there. Thank
Okay,
you.
perfect. Thank you both so much. Much appreciated. And if you could send me the presentation after this session so that I can share it with the participants afterwards, that would be great. So yeah, thank you to the buddy teams for the recaps for today. With that, I will move into introducing our two mentors for today. So YAPU's very own Christoph Jungfleisch and Delphin Ngamije. You probably remember Christoph from last week's session. He was hosting that session last week. He is the founder and managing director of YAPU Solutions, which provides the world's first operating system for digital resilience and adaptation finance. And Christoph has built a career around promoting scalable, inclusive climate and nature finance. He's held various positions in the areas of MSMEs, micro and smallholder finance, as well as advised financial institutions on climate finance strategies and operations. And Christoph is actually also the main initiator of Scale for Resilience, which is one of the main reasons we are here all today. After that, we also have Delphin, which is YAPU's regional director in Africa. He oversees YAPU's strategic objectives in the region. Delphin is also a recognized expert in risk management, green finance, and digitalization of loan processes. He has over 15 years of experience in the microfinance sector across Africa, and throughout his career, he's also led major projects aimed at supporting financial institutions in integrating climate risk and financing adaptation solutions. So with those introductions done and that foundation laid, I would then hand over the virtual mic to you both, Christoph and Delphin. Thank you so much for being here. And the floor is yours.
Thank you. And hello to everybody. Some we know each other already. For some, it's the first time. Let me lay out quickly what we're going to be doing. Basically, running through what it actually means if, as a financial institution, again here the focus on financial institutions, if you want to implement resilience finance, and everything entails. We're going to have 5 sections. A first very short introduction, what we do as YAPU, so that you also understand certain biases that we will obviously have as part of this presentation. We're then going to be looking at what basically the conceptual basics are. You have heard many of these already. I will just resume and try to establish the link of climate risk management and resilience finance in financial operations, specifically loan operations. Then we're going to be looking at the big topic of taxonomies. Everybody's talking about taxonomies. We have now a multitude of taxonomies being created on all ends from all types of institutions at government level, at economic bloc level, like in the EU. And also at institutional level. Then looking at, okay, once we have the basics secured, what do we need actually for the implementation? What are also strategic implications? And then we're going to be looking at a very concrete case. I shared a video yesterday in the WhatsApp group so that you get a feeling. It's a case from Senegal and it's a case in agriculture. But I will guide you through to understand why this, it doesn't matter that it is in Senegal and it doesn't matter that it is animal husbandry. It is the structure, and we're going to be looking at how we at YAPU at least run it in our app, because everything around digitization, traceability, the tracking of operations, and overall transparency are crucial for the benefits that can come from resilience finance, and especially resilience finance for the most vulnerable, which is our specific vision and mission, or mission rather than the vision. So I'm gonna be trying to share my screen, and somebody needs to indicate me if you can see my screen.
Yep, we see it.
Excelente. Now you should see it full screen. Yeah. So strategic and
it's kind of small. I don't know if maybe you can.
No, not again. Not again. Not again. Let me see. And I have this.
It's showing up on the left upper side of the screen.
Oh, there we go.
It's good.
Now
Perfect.
it's good.
Is it better? Okay,
yep.
Perfect. I don't really see you. I should be seeing hands up. If not, just interrupt me. So overall, very important. We need to be very aware that we know, I don't want to say we don't know anything, but we know very little. What do I mean by this? When it comes to the dynamics between what specific climate threats are and how can we respond and how can we prepare, how can we adapt to these climate threats, it's close to nothing that we know vis-a-vis what we should know. Yeah. So we have so many types of businesses. If you only look at agriculture, in our database, for example, we look, or we could be looking at over 2,000 crops worldwide. Yeah. So each of these crops, and let's stay with this, it's the same for service businesses. It's the same for small commercial traders. It's the same for any type of business, be it transportation or be it any manufacturing job. Obviously, if you look at all these types of businesses, each business would need a different type of adaptation strategy in order to mitigate potential climate threats this business is exposed to. And this is one of the big questions we have nowadays. How do we close this knowledge gap? So this is why you will always hear us, at least, focusing on digitizing operations around this. Not so much, but also obviously to increase efficiency, but mostly transparency and traceability towards investors, and then the learning, starting to understand. And this is why I'm working in this field now for 12 years, a bit more than 12 years, exclusively on adaptation and resilience finance with the UN programs and different and in different positions, and obviously with YAPU also for different customers and clients. But we will always be looking at, okay, how can we close it? And it's better to get started and learn on the way, which is very opposite to how we normally used to be working in the financial sector. We wanted, even though we are traders of risk, we want to have it as secure and as controlled as possible. And this is where adaptation and adaptation finance and ultimately resilience finance are quite different, because we know too little and we need to start learning. So call out really, be aware of this knowledge gap, and we're going to be seeing what this actually means in a case study together with Delphin. And be aware that this is why we push always for the digital part. So what are we doing as YAPU? Well, smart finance, people first. So we focus on the smart financial approach. We put people in the center, digital and inclusive resilience finance, inclusive, so especially the most vulnerable, that they are involved. Digital, well, I had my pitch on this. What are we talking about when we talk about the most vulnerable populations? Well, first of all, we have a lot of taxonomies and approaches. You have the task force on climate-related financial disclosures, nature-related financial disclosures. You have ISO 14030 or 14090. You have different frameworks that are coming up. The climate bond initiatives, resilience principles, and their recent taxonomy, by the way, again, a taxonomy, but they're usually and mostly not focused on the needs of 4 billion people on this planet. So we are talking the youth, the poor, the elderly, and in many cases, women. Yeah, so we are not exclusively focusing on women, but it is just a reality that in many countries, women do not have the same rights and opportunities than men have. So there's a specific focus on this. But everything we're going to be looking at today can be applied to other marginalized groups too. So migrants, for example, or youth as another type of vulnerable groups with a lack of access. So these 4 billion people usually have very difficult choices. Yeah, so either they stay trapped, they cannot get out of their local situation, so they are exposed to certain climate threats, or they migrate. And when we talk about resilience finance, it's more than just financing some solar home systems or photovoltaic system. It's more than just looking how do we apply the latest seed variety, or how do we improve the building materials and the building structure in order to face, for example, extreme heat. But it's obviously everything around production. So the introduction of adaptation solutions, it's ensuring safe and resilient housing. So it's every business usually has an owner and has employees, and those live in houses. Have the access to basic services like energy and water, obviously. Strengthen ecosystem services, a huge topic when we talk about nature. Nature gives us services, we need to strengthen them. You open the tap for water, this water is coming from somewhere, and you need to make sure that this water keeps on coming. So we have situations like in California, or like in Mexico City, or in large parts of Turkey, where we have groundwater dropping so much that not only industry and agriculture are affected, but households in the first place. Implementing sanitary measures, this is everything around wash, or this is everything around water filters, and goes in the same direction than access to basic services. Developing income diversification, this is usually, especially for MSMEs or for micro businesses, usually the first focus is how do I diversify my revenue streams so that if one fails, I have others I can rely on. The household with different members working on the field, the joint family field, but having one son working in a factory as a salary, as an employee, maybe running a taxi and having a small shop. So looking at income diversification, and then obviously building disaster recovery ability. Insurance, for example, I hear this often for adaptation, for resilience. Insurance is so important. I would not agree. And I think I might even have said that already last week. Insurance is always after the fact. So this is when the damage has been done. I can claim, and hopefully I get a compensation. Yet, if I don't address the risk, at some point the premiums will go up so extremely that I'm either non-insurable or that I cannot pay it anymore. And we see this, for example, with the recent wildfires in LA. So what are we doing? Solution is, yes, it's all about digital. So we have an app, we have a platform, we manage and we identify climate risks. We enable to recommend specific solutions to end customers. We document and we help to document digitally all loan details. And what is important for investors is we help to avoid greenwashing. And then magically everybody adapts successfully. That's part of a pitch. So obviously it's commercial, but that is providing at least the idea of what we are doing. So over the platform, we have enabled over $450 million in resilience finance in more than 100,000 loan operations over the last couple of years. Since COVID, obviously, this was not a major focus, but now it's picking up again. We work on two main levels, transaction and portfolio levels. So at the transactions is basically gathering certain data and then having it expressed in a risk report. And on the portfolio level, it's basically looking at from different angles what is happening in the portfolio. So how many disbursements do I have? How is the portfolio performing as per sub-loan categories? Then segmentation by gender, by geography, and ultimately also externalizing or at least visualizing the level of climate risk that we have in a specific portfolio. So that's what we do. I need obviously this also to introduce you a bit to our work, but let's look at the conceptual basics. First, why should we engage in resilience finance at all? And resilience finance is really taking into consideration the climate risks and the responses. And we will look at this in greater detail. Well, obviously, we might have regulatory pressure. Financial institutions, especially banks, but also some parts of non-banking financial institutions are usually regulated, especially if they are deposit taking. So we need to show how we treat especially the deposits in a responsible way. So if we extend loans and don't consider climate risks, there might be a risk that we aren't considering, so regulators start to push for it. So in some countries, this is quite advanced. In some countries, it was advanced and it's now rolling back. You might know of who I speak. And in some countries, it's coming. So for example, India is just now introducing their new regulation, which obliges a certain part of the financial system and of the real economy to disclose climate risks, and others are invited, and then gradually this will be broken down. So till everybody reports on the climate risks they have, and both levels, active and passive, the one that might affect the institution itself, but also the one that they are causing, on both physical and transition climate risks. Physical is the concrete risk of an asset. Transition risk are risks that are stemming from regulatory, legal, demand and market changes that might affect the business due to climate change. So for example, if I'm a chocolate producer and I offer only industrial chocolate, market moves in the direction of organic chocolate, which is more resilient and has a higher price, then as I'm not offering this, I might have a hit on my revenue level. So this would be a transition risk. So regulatory pressure forcing us to attend the topic. TCFD, TNFD for the nature part, so the Task Force on Climate-Related Financial Disclosures, they have a pretty standardized set of recommendations on how you can do it. Everything you will hear today is aligned with these recommendations. Second is investor demand. I know that we have some here in the group that are working with larger banks or even with development banks. So those that have been exposed, for example, to the Green Climate Fund, there is very specific requirements of eligibility of what can be financed with the money coming from the Green Climate Fund. And we see this across the board, especially in inclusive finance, impact investors that are focusing more and more on, okay, I want disclosure of the risks, I want disclosure of the impact that I'm generating with my investments. And there is definitely on capital markets, there is even a non-monetary premium if I can show that I'm investing in climate. I have a clear market and distinctive advantage at capital markets. But maybe most importantly, and this is something which is for us that we are working in this for a long time, quite encouraging to see, the client needs. So encouraging in the sense that that the demand for concrete solutions is getting ever more pronounced as we see a pronunciation of the climate risks. So obviously clients, they are very well aware about the storms that might hit them, the extreme heat or the strong rains, and they're looking for solutions. And obviously as financial institutions, we are serving the retail markets and we're serving the real economy. There is a concrete need. And this need is getting better expressed. So encouraging in a sense that it is not a theoretical mental exercise anymore, but it's very concretely woven into the real economy. So when we look at climate risk, and this is pretty much also what is, for example, written in the recommendations as a basic scheme, as a basic mechanism, we call it a working thesis. It's basically you have the net climate risk, that's the exposure plus the sensitivity minus the adaptive capacity, and express per each climate threat that we can identify. It's a bit more complex, so it's a working thesis or it's a simplification, but it's basically exposure establishes baseline risk, the sensitivity increases or decreases the concrete impact my exposure to these threats can have. And then with the adaptive capacity, I can go against it. I can strengthen my adaptive capacity. So let's look into that a bit more in detail. So the exposure depends on the location where I am. While I'm staying in a location, I have an exposure to certain climate threats. That's usually based on microclimate and macroclimatic factors. We usually can measure this by looking at what has happened in the past, what are recent trends. We know that we have most of climate change happening over the last 20 years. So I can have certain projections. So the IPCC, as international panel on climate change, they are, for example, managing certain databases. Then you have private providers, and obviously you have an abundance of research institutes and non-governmental institutions and organizations that are working on this. But as long as I am in a given location, I'm exposed to the climate threats in this location. It's highly probabilistic. So I can have a 99% chance that I will be hit by a hurricane, and it might not even happen. Yeah, so this means we have no security or certainty on what risks will really materialize. And this is where it also becomes difficult. And obviously, if you have like a recurrence of disasters, it's much easier to get adoption in the market for specific solutions. If you have a wide variety of impacts, obviously it's more difficult. So the sensitivity depends on my asset or on my activity in this specific location, how sensitive this asset or activity is vis-a-vis specific climate threats. So let's stay with the hurricane and let's look at two neighbors. One neighbor has a solid concrete house with I don't know, with a certain type of roof, and the other one has a wooden home. Yeah, who is more sensitive vis-a-vis category 5 hurricane? Well, obviously, at least in this situation, you would expect that a concrete home is more or less sensitive towards strong winds and hurricanes than a wooden home. Yeah. I'm just trying to provide examples. They might not be always entirely correct, but this is the sensitivity. It's much more clear if you look at strawberry production and agave production for tequila. A strawberry needs a lot of water, and agave can work with very little water. So in agriculture and also for animals, obviously there's a difference in terms of the amount of certain inputs they need and how sensitive they react to specific climate threats. And then the adaptive capacity is really a set of practices, inputs, equipments, installations that we can apply in terms of technology, but also just on how we manage a business, how we manage a crop, that we can build up further. And this is where even if you, and especially if you talk to scientists, if you ask them, okay, I have an agave production, I have a strawberry production in a specific location, what is my best adaptation strategy now in order to have like a stable production of strawberry in this location? You usually will need ridiculous amounts of money so that this agricultural or agronomist expert helps you to identify the best strategy. And this is because there are so many factors that we really have a hard time to assess and then extrapolate to other regions what the best solutions are. And this is where I'm saying that we have a huge knowledge gap. We don't know. Yeah, we don't know what is the combination of several climate solutions that will increase or decrease the climate risk for a specific customer. So, but we can assess climate risk in a standardized way, and hence we can implement them and integrate them into daily operations. So there are methodologies out there. it is not only to identify and recognize and measure the risks, it's primarily about identifying what are the solutions, what are the answers to these identified climate threats. And by focusing on the solutions, we can start promoting really the investments into adaptive capacity and into climate. And it's almost the same in terms of the principles and basic concepts in terms of climate and nature risks. So just summarizing, exposure is based on a geolocation. I can, with any normal phone, I can have a geolocation and I can pinpoint where I am on a map. The sensitivity depends on my personal situation, the activity or the asset, and the adaptive capacity is what technologies, inputs, equipments, installations do I put on top of my asset or my economic activity in order to limit my vulnerability, increase my resilience. And these adaptive capacity, at least when we are working at YAPU, we organize in taxonomies. And as there are so many taxonomies out there, and there is so much also, yeah, I don't know how to call it, politically correct, but there's so much theoretical debate, let's say, around what is the right approach, etc. We try to put it down onto an operational level. So how can we have it in simple language so that it is really retail business, MSME business oriented? It's not like some theoretical abstract approach, but very pragmatic, tangible, and hands-on. And we organize this then in a standard set of categorization, detailing it in such operational taxonomies. And this brings us, if we look and just summarizing, what is the connection between the climate risk and credit management or credit risk as the main asset on the balance sheet of financial institutions? We have the climate risk as a function of exposure based on the geolocation, sensitivity according to type of asset and activity, and adaptive capacity as organized in taxonomies of available solutions, climate solutions, adaptation solutions. You can then say, if you only look at the exposure and sensitivity, you have something what we call gross climate risk. It's without considering any mitigation investments, any adaptation investments that we have in place. And we have the net climate risk, which is really like the residual risk once I have done what I have done so far in order to adapt to climate change. So if we extract or express this now on a per transaction or loan basis, we have the link to the credit risk management. So you have the usual KYC procedures, then you have your risk analysis, be it a scoring, be it some social scoring model or social setup, or you have cash flow based lending. You then usually take a loan decision. And if you have one part of what you are financing with your loan, focusing on a resilience investment, this loan, or at least that part that is oriented towards a resilience investment, becomes an instrument for resilience. And this is where we start like building up specific portfolios, green inclusive finance or green finance portfolios, which promote a risk reduction as we apply new practices, new inputs, new equipments, new installations, and new other assets that increase our resilience. So what is very important for all of this are taxonomies. Yeah. So let's have a look at how a process could look like, and in fact for us looks like for developing such operational taxonomies.
Christoph, we have a question from Natasha.
Yes, please, Natasha.
Very good presentation. I have a question or maybe a comment, which continues to be one of our challenges here at the Grenada Development Bank, is that if you go back and when you look at that net risk, where we would have improved the resilience and the adaptive capacity of our or borrowers.
Mm-hmm.
The challenge that we have is those interventions are not translating into any cash benefit, let's say, with the insurance.
Yeah.
You mentioned insurance earlier on as an sort of after the fact. But what we find is that in our jurisdiction, that insurance premiums are typically based on property value, replacement value, that is. So when you would have created all your resilience and improved your properties to make it less resilient, more resilient, that doesn't translate really into any net benefit. Of course, you're able to withstand an event, but there's no, how should I call it? There's no incentive.
Yes.
Really.
Yes.
For the borrowers to go down that route.
I absolutely agree. And this is a flaw. Thank you, Natasha. And yes, I totally agree. I think this is bound to change. I don't know if in this round, I can say I have a home in France, and they wrote to me and said, you are in a flood-stricken area. The state, the province wrote to me, you're in a flood-stricken area. You need to do A, B, or C. It was a total of 7 different solutions. Implementing on the home. If not, your premiums might go up or you might become uninsurable. So that's a negative incentive. So I do this in order to be insurable. But I totally agree. I have never seen the opposite, that they say, oh, you are more adapted, so your premium is lower. Even if I have, on the other way around, if I have an insurance for my agricultural productivity, for example, my interest rate with the GDB or with any other bank should be lower because my risk is mitigated. So you cannot apply the same risk profile to me than you do to somebody who does not have an insurance. There is clearly, and I think this is a lot of effort needed there. A coordination between financial institutions on the banking side and financial institutions on the insurance side, that you need to factor that in. I can tell you, I have worked in the insurance sector myself, and I can tell you that actuary models, which are usually much more complicated and much more sophisticated than actual credit risk models, they don't have access to this data. And this is what I said as one of the, in German we say Gretchenfrage, the biggest open and the biggest knowledge gap we have is what solutions provide the best adaptation or adaptive capacity benefits. An actuary, as long as they don't have the data that show you, okay, I have a flood barrier, so my risk is diminished by 17.38%, that I have damage to my home inside. So my premium should be reduced. As long as we don't have this data, we really have the problem that you will have a hard time to coordinate between the two of you and solve that situation. That is why also everything I'm saying today is let's close this data gap. The sooner we close this data gap, and we're gonna have a look at one data example we have from Mexico, where you see, okay, now it's going in the right direction. And also us, and we focus exclusively on this, we are still far away of having really a position where we say, yes, insurer, we can show you that you invest in this customer of Natasha, you have a much better profile, so the premium should be reduced. As long as we cannot provide these data, it will be almost impossible. I know that's not satisfactory, but that's what I can do in that short time.
It's understood.
There's a lot of work still to be done. I think with the increasing acceleration of climate change, this will probably and possibly change over the next couple of years, and rather towards 2030. I think I have a confidence that we will have a big step forward also with the latest large language and reasoning models, where you can start like analyzing data, big data in a totally different way. Let's work on it. Taxonomies, this is the basis in order, and I will refer back to this example of Natasha. I will refer back to it. If we start understanding what climate solutions have the best impact on the risk profile of a final customer, the better argument we have also to either have risk-adjusted pricing in the lending rate, in the interest rate on a loan, or also risk-adjusted pricing for the premium payment. That obviously would provide also further economic incentives for adaptation. So how do we work? We have a global taxonomy of over 450 climate solutions in 6 economic sectors. We have selected them if they pay in onto 4 different objectives of increasing climate, nature, health, and socioeconomic resilience. And we check if they provide certain co-benefits, a carbon footprint, environmental footprint, and social footprint, basically. Why co-benefits? As long as there is no monetary benefit, we don't care. Why don't we care? Obviously, me, myself, in my nice home in Germany, and you probably in your nice home, we all care. But in the end, final customers, end customers, they have a different focus. They want a loan to invest in something which increases their life quality, their revenue potential. So we are not looking non-monetary benefits. Everything is co-benefits. And then it's all about how to select these investment objectives. So the conditions are at least supporting one objective, not harming any other objective, maintain and not harm basic safeguards like human rights, like gender equity. And then, and that's the most tricky part, and it's the same font size, comply with technical verification criteria. So to consider an investment in adaptation or resilience investments, and there's usually a set of technical verification criteria that this investment needs to comply. So if you're financing it with a loan, that this loan is considered a resilience and adaptation loan. This can get very tricky for high technology items, can be rather simple for very standardized items. So technical verification criteria for a PV system, well, if you have the PV system and it's certified, then that's it. Yeah. For other, especially if you go into agroforestry, organic or regenerative agriculture, then it gets a bit more tricky to verify if this really qualifies. But usually that's part of the selection criteria. And then what are the anti-greenwashing mechanisms? Well, digital MRVs or M&E systems are key. That is really what will drive everything when it comes to avoiding greenwashing. And this is where investors are really like, no, we don't get involved in if you cannot guarantee this. Loan portfolio certification, have somebody independent looking at a loan portfolio in order to identify that this is really a resilience and adaptation finance loan portfolio. So we have these 450 solutions. That's too much. Our final users usually are loan officers, client advisors that talk in direct contact with the customer. So we have a prioritization. We filter these 450 solutions. We have a first filter where we just say, okay, what is not applicable because the climate risks do not fit, or because it's just not applicable to the country or to the institution, the institution's area of operations. We filter them out. We usually get to some 150, 200 solutions, depending on how many business sectors we are looking at. We then have an expert filter where we work, in some cases, we have worked with UN programs, experts from UN programs, or experts from a Ministry of Agriculture or Ministry of Environment, where we filter and say, look, this is not applicable here. We have tried it. It has not worked. There was no adoption in the market. So we bring it further down. And then we look at adoption rates in the markets, usually with field personnel and front office personnel of the financial institutions. One call out, at least for those of us that work in financial institutions, you know much more than what you think you know. Yeah, so while we are not knowing what the best solutions are, usually our field staff that is on a day-to-day basis with customers, and at least in inclusive finance, usually in the field, they are not sitting in an office, they are going out and they're visiting customers. So they see what the reality is of the customers. And they know which of these solutions are actually in place and which are not. So that's our last filter. Usually with these three filters, we apply, and then we go into production. And then based on administrative records, if you track this for each loan, yeah, if you do this analysis and based on the taxonomy, you also measure the adaptive capacity. Basically, you get statistics based on all loan operations that you are applying. And then you can start like focusing on specific solutions which have the highest adoption rates or the highest demand rates. And this is a bit the logic on how you transform a simple catalog of solutions into a powerful mostly credit and loan instrument to foment resilience. This is then an example we have here. We usually look at 6 different sectors: agriculture, animal husbandry, service, manufacturing, trade, and housing. And then we have, you see some examples of these solutions below the numbers of total solutions that we have per each sector. And then we look at data analytics. So when I say this third filter with loan officers, this is how this looks like. We basically get a yes or no if they have observed certain climate solutions in the field. And then, more interesting, I hope you can see at least that it gets more detailed. We can get statistics from operations. And this is something everybody can do. As long as you know, and I know that most financial institutions, you might not always know what your customers do with the money, where they invest it. I can tell you already now, yesterday we had a call with a large MFI network in the region, well, in Latin America. And they said, yeah, well, our institutions, they don't know what they're actually financing. So we do not record this. That's fair if you have consumer loans. That should not be the case if you have productive loans. So you should know what your customers are doing. You might take into consideration the cash flows which are stemming from this investment, etc. So there really more information is better, and we should get to this level of analytics. That as a general introduction, taxonomy, it's one process how we are doing this. I know that there are much more complex processes out there. Natasha, for you, for example, obviously, if you're looking at a country level, you need to address it differently. That's not the focus we are trying to push forward here. Here, it's really like make it operational, make it tangible, make it focused in a simple language also to the benefits and to the demands and requirements of the end beneficiaries. Now, what does this mean for implementation? Well, first, what are we targeting? And this is a bit, if you look what the international climate negotiations are, it's all, we have huge adaptation financing gap between 300 and 500 billion per year. Some even talk about trillions. So it's a lot of money. And we also know, and this will get worse now with the US dropping out, at least for 4 years, probably longer, that public funding is very limited. So we need to get to capital markets. So the quest is, how do we gather all this data and build a business case in order to have, for example, bond issuances or any other type of refinancing from international capital markets. And what we are saying is capture the data at the field, supervise what is happening in your portfolio, make sure that you have 100% of operations assessed and analyzed for the climate risk. What I tried to show before is it's possible, and we're going to be looking at it in a moment with Delphin, but try to have this analysis for all your operations. And then start like working with external certifiers that somebody can say, yes, we have reviewed it, and we say this is really like resilience and adaptation finance. We usually, and this is something we will share this, those are all typically our or part of our consulting services, but we will share this at least for your orientation is then obviously translating it into a data smart, and in our case now a gender responsive finance strategy. So what we want to identify are what I would call gender clusters. So where do we have a higher than average number of women-led businesses, which we might want to finance? And where do we also have like a higher women-led service provision in terms of adaptation solutions? Those are the two angles where we could be focusing and promoting gender inclusive resilience finance. And then everything, at least for us, is based on the resilience finance operating system. So I have a whole suite of topics that the financial institution implements. And then I have 3 strategic pillars. Read through it. It's all about analyzing data and then basically applying, once you have this data set up, we apply very traditional awareness raising, capacity building technologies, be it focus groups, be it trainings, be it field schools, in order to build the capacities in the communities. That is then following again face-to-face, because that's important for these clients, face-to-face interactions in order to promote resilience investments and adaptation investments. So what does this mean? Financial institution starting, it will always start with the digitization of lending processes. If you're not yet digital, that might for some of you maybe sound very strange. Of course we are digital. Many institutions are not, and even more so in the inclusive finance sector. And there is no argument against digitization. It is getting so cheap, and it's so accessible, and it's so standardized, and it's so secure that there is no argument against it. So gather data in a digital way, have rules defined to process your data in order to prepare basically lending decisions. You can even automate or semi-automate these decisions. You can apply all types of lending methodologies. You can have it scoring-based, cash flow-based. You can have it group lending, individual lending. There are different ways on how to do it. And as of today, digital solutions can reflect them all. Secondly, start to implement data smart approaches also in order to check plausibility and have comparison. We call this referential data systems. And I will show an example from agriculture because it's just the nicest one. The same applies for any type of other businesses. Basically, what you do is that you look at the basic cash flow patterns and the business dynamics. So obviously, bakery has a different dynamic than a certain crop that I'm producing. But also bakery has better days and lower days in the week. They have certain prices they are depending on, for example, for flour and water and energy. And we can see what are typical margins. Usually, if I remember well, it's about 40 to 50% gross margin for bread that is being sold. So, and then I can establish these referential data and I can compare it to a specific client in order to judge if the statements of the clients make sense or not. We have done this in the EcoMicro project, for example, in Ecuador. We have built over 700, almost 800 crop cards across 23 provinces. Those are data cards which establish and enable the standardization, automation of lending and increasing efficiency. Climate risk and loan verification, just our example, obviously, you take on the information from the borrower and you get an automatic climate risk profile. We're going to have a look at it. Monitoring and evaluation, as you are digital, you can start like looking almost on even in real time, what is happening in my portfolio? How many loans for which climate solutions? What is the climate risk of the different loans? And I can obviously have a breakdown. Everybody works the same in these solutions. And then maybe for larger banks and development banks, obviously the whole topic of on-lending. So often you have the appetite. We see this in larger countries, for example, where larger banks are financing small cooperatives or MFIs, but we see this specifically also for For development banks, obviously, well, I want to on-lend via some cooperatives. What do I need to do? First, you do the institutional assessment. We have seen this with Natalia last week, so we can see what the institution is already able to do. With some of you on that call, we even have done it with us, also based on the Green Index 3.0. So it can be light touch, it can be very in-depth. There are different ways. Work with the on-lending institution on adhering to your own resilience finance strategy. So basically, you want our financing, you need to follow our disclosure rules, climate and nature-related financial disclosure rules, our strategy, customize your taxonomy. If you are, for example, working with a cooperative or small MFI, which is focusing more on agriculture, more on fisheries, well, then you adjust to them. And you can do the adjustment of the taxonomies also for different types of organizations. Build the capacity of the management and of the staff, of course. Have your own lending platform that you can deploy to these institutions, and apply the same M&E and certification logic to the resulting portfolio of the on-lending institutions. 100% taxonomy alignment is a requirement, documented disbursements. So we need the details of each transaction, and it needs to be verifiable and auditable in order to be transparent and traceable. That all goes back from the field, basically, to the capital markets. What are the requirements in order to get to capital markets? So this was now 40 minutes, 44 minutes introducing. Do you have questions on this before we look very briefly at one concrete case study? Druckbetankung nennt man das auf Deutsch. No questions? Then I have a question to you. What is hindering, and I would love to have your feedback, what is hindering your institution concretely, if this applies to your situation, to implement climate risk management and proactive adaptation and resilience finance? Maybe somebody can give me some orientation. Have I killed you with my speedy presentation? Yes, please. Joan, is it? No, I cannot see it well, but you're mute.
You're muted. Mm-hmm.
Yes,
I don't work for a financial institution. I used to work for a financial institution. So my comment would be more in location wise. I would talk about Haiti. I think there needs to be a broader understanding of the financial institutions and the credit officers, because that is a first issue, because if they're not trained in identifying the risk and identifying the specific product and the need of the customer, they will not understand what category it falls into. So even though there is climate funding available in Haiti through the central bank, but because the credit officer don't understand the nature and don't understand how applicable it is, they do not categorize the loans under that category. So the people do not benefit from these types of funding. That is the first part. And on the second part, what I noticed in the portfolio of the financial institutions, and specifically of the credit unions that are more spread out on the territory, is that the due diligence for the customer is very difficult, specifically when you're in rural areas, because when you cannot do due diligence, you have no access to any financial instrument. You cannot talk about insurance. You cannot talk about opening account. So there needs to be Haiti-wide, there needs to be a campaign oriented towards those two objectives to be able to talk about climate finance. Thank you.
Perfect. Joan, perfect. Let me just briefly react to it. First, yes, the awareness and training, huge blocker for it. But usually we have super good experience with developing these operational taxonomies. And this is why I stressed, I think, several times, simple language. Yeah, not some, super technified and abstract approach. No, it's a drip irrigation system. It's a green roof. It's an adjusted seed variety. It's A, B, C, D, but it's concrete and it's very simple. And you will see now how we break it down onto the core items for loan officers, for the personnel, but also for the financial institutions, final beneficiaries.
Yes, absolutely.
If happy also to engage beyond our session today for anybody here, we can have also bilateral check-ins. If you have these situations, usually it's straightforward on how to run this. Honestly, there can be done a lot with very simple means. Yeah, I'm happy to engage further. The second part is, and this is something I saw it in Haiti. We have worked a couple of years back with some partners there. I saw it in other countries in the Caribbean. I was quite surprised to see that many financial institutions are super bureaucratic. I saw somebody wrote collateral. I just saw it from collateral requirements, documentation requirements. It's like I see financial institutions in the region, in the Caribbean, applying standards that I need to do in a highly documented and formal country for larger loans. Yeah, I'm talking like several times my monthly salary. Yeah, when I have something, my monthly salary, that's like this. Yeah, so and you are close to Latin America, which has some of the most sophisticated microfinance approaches, which have shown that even if you don't ask for the collateral and even if you don't ask for all the documentation, they still pay back. Yeah, so there are solutions which are around the corner, which are not being applied. And I think this is even more than the capacity we can build with customers and with loan officers. But this adjusting your eligibility criteria for loans, especially for micro businesses, that needs to be adjusted. I totally agree.
Absolutely. I would add, you said bureaucratic, but it's more of a lack of training to be able to have some souplesse. How would I say souplesse?
A bit like sensitivity
flexibility.
Yeah.
Because if, for example, I cannot have the proof of address of a client, as a customer officer, I can ask for a specific number of the electric pole that is next to their house that delivers the electricity, and I have the GPS location right there. So it takes training. Thank you.
Yeah, and processes, no?
Absolutely.
I wanted to respond to your last comment there regarding the collateral, etc. From a DFI, a lot of these requirements are not just from the financial institution. In our cases, some of that comes from our funders. Yeah, so
which is strange enough,
I keep saying follow the money. Depending on the source of the funds, those are requirements that are stipulated. And it's part of the monitoring and the audit. In addition to which, some of it are regulatory requirements. You're monitored based on your performance and whether or not you're giving bad loans from the start, quote unquote. So while I understand the need for flexibility and also training, those are valid. There are also additional challenges that financial institutions. It's a difficult balance. We want to give the monies out, but we also mindful of who's behind our back, making sure that we're doing it the correct way. So all of it is good, but it's about finding balance, I think, and ensuring. I mean, if we get funds, no strings attached, we can give it out tomorrow. That's not an issue.
But it's not no strings, no? We need to do KYC and risk analysis, but yeah, no,
but in terms of the customer requirement, what's required from the customer.
That's the point.
That's usually a
regulatory topic, no?
Yeah.
And I was referring with my comment more to the regulatory setup. So not so much on your level, not on your level, on the financial institutions. You are usually, and especially Natasha, you as a development bank, obviously you cannot get a millimeter out of the regulatory stipulations, yeah. But the regulation needs to be adjusted, and this is where I'm saying that you have very successful markets in Bolivia and Peru, for example, Colombia, in some of the countries in Central America. You can copy and paste. Yeah, they have regulations which say yes, you can lend without a collateral, and it's not increasing your provisioning by 300%, for example. Yeah, so there are ways and regulations. Good, Veronica. You're mute. You are on mute.
Yes.
Yes.
Okay, so sorry. So I agree with both of you on two different aspects. I agree with Natasha that in many cases, a lot of the requirements come from our funders. So that's one. But in terms of, let's say, other issues such as regulatory requirements and so forth, we are implementing a lot of the things you touched on, such as, for example, an environmental and social management system. We have recently developed an M&E framework and are just now implementing that. And there are some of the things that you really need to sit down and think to scale. For example, our ESMS was developed, and when you look at it, it seems to be so cumbersome, and I think the key there is to really fit it to scale. It really needs to be fit to scale for it to avoid a lot of bureaucracy, avoid a lot of things, but while maintaining and meeting the standards that we're based on, for example, the IFC performance standards. So yes, there's a lot of things that can be cut out. In fact, the whole reason the Development Finance Corporation of Belize is now moving or changing its core management system is because it's really to eliminate a lot of bureaucracy, because what we found, or what I was told, is that maybe like 3 years ago, to get finance for one small project would require about 50 files, which would be the same that you would have for a big project. So it's a matter of really making it more or less bureaucratic for small loans versus very big loans. So I agree with that part.
Yes, that's usually the approach, and also ESMS is a good, and then I will ask you another question. If you want to see the case study or not, you can maybe, while I'm just reacting to this, you can raise your hand if you still want to see the case study. But just responding quickly on what you just said. ESMS, yes, if you do it completely, you need to do a full assessment at client level, and then you need to develop action plans, right? If you go till the end, you can standardize these. You can, if you digitize, you can really bring it to the level that you say, look, I have these questions. This is what I saw with the customer. And then you have a recommendation. We do it via recommendation. That's not an action plan. That's a recommendation. But so there are ways on how you can standardize it and simplify it. In the end, what do you want your customer to do? Primarily, I would expect, and Belize at least, is that they are more resilient to climate shocks. But that's also my personal preference. Also, this disclaimer: I never understood how can we ask a smallholder farmer or a micro business that they solve the emissions topic that we have created here in Germany or in Great Britain or wherever it is. So this mitigation focus, sometimes I think I really don't like it. Yeah, so I'm biased there too. But you want an action plan where they say, okay, this is what we do, maybe better recycling, taking care of the ecosystem services, etc. In order to protect their own situation, enhance their living. And then, yes, where you also we can check in, but look at how you can standardize it and cut some corners. It sounds gray or it sounds bad, but simplify your process also on the ESMS so that it is scalable, as you say. I think that's a key challenge.
Yeah. Yes. I would just like to say, yes, I would like to see the case study.
Okay.
Yeah.
Then if you are okay, I invite you, if you have further questions, Nicole, I see you. I don't know if you have a further question. I would take one last one. If not, we would go to the case study. If not, Nicole, you are invited as everybody else. Drop me a note via an email. I will see that I respond as best as I can, as fast as I can.
Sorry, no, Christoph, I was just responding, raising my hand as interested in the case study. Hi, good morning, everybody.
Perfect. Hi, good
Thank
morning.
you.
If you want to take... Hi, Nicole. Glad that you're here. You can make it. Christoph, if you want to take one last question, we have one in the chat from Donna. Asking, do we have settlements then through institutions to settle green financing and using a different framework as opposed to actual banking institutions?
Settlements? Do we have settlements? I don't understand this.
Maybe
very
referring
well.
to microfinancing or less in terms of loans, he said. Yeah.
Well, you have in some countries, you have so opposed banking. Well, obviously cooperatives, you have NGOs. In some countries, so we have, for example, now I'm getting confused. To settle green financing using different framework as opposed to actual banking institutions. The framework, all frameworks are usually oriented towards TCFD and the TNFD, and typically everything around taxonomies as a framework too is orienting itself at the EU taxonomy on sustainable finance. When it comes to different types of loans, well, obviously you have innovations which go beyond mere loans, where you can have micro leasing and where you can have all sorts of different design of these financial products. But in 99%, that's plain vanilla lending, I would say. Yeah, that's really like a productive loan in all types as they come for small businesses. And at least our hypothesis is green lending is actually not different to gray or brown lending, in the sense that the processes are the same. What you usually have is that you might have some concessionality and some benefits. You might have some more reporting requirements, but overall the processes are the same. If I'm investing into adapted seed varieties or GMO seed varieties, it's both inputs, it's both seeds which I need for my annual crop. It doesn't make it. It doesn't change. It doesn't change the process. What might change is maybe the marketing, etc. So I'm not sure if I understand and if I, in consequence, respond well. If not, we can dig deeper. But I would go into the case study so that we can have a look at how this is looking in a very concrete situation. Delphin, are you still there? Are the kids back at home? Delphin usually takes care of the kids, and I think it's close to 7 for you. So let me know if you are not there anymore. I will start presenting quickly the customer. So what is the situation? We have developed a training together with our valued partner, the World Council of Credit Unions. We have delivered it based on 2 case studies they had developed in Senegal. One lady growing strawberries, and one gentleman producing chicken eggs, mostly. And we have looked, okay, as it is coming from a project that is focusing on climate adaptation, what does this actually mean? Did Delphin say he's there? Did I see you? Delphin, are you still there? Yes, you're there. Can you hear us? I don't hear you. We don't hear you.
Hello.
Hi, Delphin.
Hello, Christoph.
Okay.
Hi.
Yes.
Yes, I'm there.
Okay, perfect. Thanks. You have the screen connected, right?
Exact.
Okay, perfect. I will do a quick intro on what the situation of Idrissa is. We will watch the video, and then I just briefly show the climate solutions, and you guide through the app, right?
Okay.
Okay, perfect. So the customer, we are looking at Idrissa Diouf. He has a business of chicken. He is producing. He has 1,000 laying hens. This is how he started. He has permanent staff. He has grown considerably over the last years. What is very good is he has quite a bit of awareness, capacity, and vision, not only on his business, but also on seeing how, in this case, especially extreme heat is affecting his business. So he plans to buy solar panels, a battery system, and have them installed in order to support his ventilation system. We have a 2.5-minute video. I shared it. I would look at it right now too. I just need to make sure that I'm sharing the sound, I think. And let me see just quickly. 1 second. Include sound, window, PowerPoint. Swap displays. Can you see it?
We can see it doubled. The view is a little weird. Are you on full screen?
Yes, I am. It's very strange. But is this now?
Yeah, we can hear it.
maa ngi tudd Idrissa Diouf nekk ci Nord Sen Iran nekk fii di def li nga xam te mooy activité aviculture.
There are subtitles. You need to read the subtitles.
Mbay mi. De bas âge laa tàmbali woon agriculture bi après ma ñëw ci élevage bi di yaraale ay xar léegi nag après loolu moo ma poussé ma ñëw xool étudier ginaar yeeg yooyu bi ma yegsee ci ginaar yi aussi ma ci sob xam nga di ko jàngantu nànk-nànk di xool poussin yeeg yooyu léegi nag moo ma permettre ma dugg ci pondeuse yi bi ma duggee ci pondeuse yi aussi voilà ma def benn bande 1000 essayé mu dox côté nen bi ñu ci bëri fi mu nekk nii ñoo leen di livrer surtout marché bi fii ci biir grossiste yu bëri ñoo leen di livrer benn nit mënul créer société il faut plusieurs personnes il faut des branches pour que li ngay def mën a aboutir fii presque lu tolloog ay 10 personnes dañ fi liggéey ku ci nekk di nga ci gis sa bopp chaque mois ñu fay la lépp activité bi moo leen téye ñu bëri dañuy ñëw xëy si fii travail ci ginaar yi ak ñam ci tool bi aussi ñu bëri fi lañuy ñëw di suturlu di ci gérer seen bopp. Pamécas aussi bi ma demee bi nga xamante ne maa ngi bëgg a yokk def extension yokkaat ginaar et tout ça léegi ma dem xool Pamécas ñu dolli ma tuuti force loolu mu mun maa indi benn apport boo xam dinaa mën a yokk sama production. dama njëkk a def benn petit financement de 8 millions après bon deuxième fois ñoom ñu gën a yokk joxe benn 18 parce que lii dafay laaj beaucoup de moyens parce que parfois aliment bi day manqué que su fekkee amoo ay moyens yoo mën a tegalee aliment bi nit yow di nga mën a dundal say ginaar te ginaar yi duñu am problème parce que dañuy jël day rupture am fii climat bi taxu ko normal parce que su fekkee dafa tàng trop il faut nga wut ay ventilation pour mën a apaiser température bi bon d'ici 5 ans maa ngi gis sama bopp nekk koo xamante ni.
Okay, so I don't know why it interrupted, but I will try to keep on. So basically, Idrissa has this chicken business, and he has now the problem that there is extreme heat. So we chose this because I think I at least have seen it in Central America, and I also have seen similar situations in the Caribbean. So I think that's something, chicken production is pretty widespread. So I hope everybody can relate. Now, what we have identified basically, and this is something that loan officers would know, they would be trained on, is that yes, for chicken, we have identified 6 climate solutions, and they have different levels of positive impact on the climate stress. So we have breeding of heat resistance, breeds, cool drinking system, mist cooling system, blah, blah, blah. That's very simplified. It's much more complex than that, but basically one has a higher impact on limiting the risk, increasing the adaptive capacity than the other. And then we are looking, and those are, for example, this is what I said with simple language. Then we have basically short descriptions of the different solutions. So what usually happens is that we visit the customers, we take on information, and we will look with Delphin at how we take on this information. And at the end, processing this information, then we can even get to a level of automated recommendation systems. If you're looking ESMS, you can get to an automated establishment of an action plan for a specific business. And here you have the details, and then you usually have a very brief description. What are the benefits? What climate threats is it addressing? And how does it actually help the producer? And obviously you can adjust this according to different value chains, according to different businesses. But this is, for example, typical level of complexity that we support institutions when they are raising awareness with their customers of, look, there are alternatives that you can apply. So we see here in red that the customer is already planning to invest in one of these solutions. So the loan for, I think it's 3 million CFA, the loan would be an entire resilience loan. But, and this is the main finding, simplified, it is not the best climate solution he is actually planning to implement. Yeah, so we don't criticize this, but we can say, look, okay, you do your solar panels and they can help you with the energy security. But look, there are other solutions which might also benefit your production. Delphin, again, are you here? I would maybe hand it over to you.
I'm here.
For perfect. Then I share and I give over to you. Yeah?
Exact. Yeah. So I'm sharing my tablet. Do you see my tablet?
Yeah, yes. We see the background screen.
Okay. Now I'm going to connect as a loan officer so that I visit the client to collect the information. So here I put my credential.
So obviously there are different systems which do pretty much the same and we take this because we have this, obviously we have this on file, and this is what we have used in different trainings. Yeah. I think you have a space there. Un espace après beaucoup. You have a space after beaucoup dot. Yeah.
Yeah.
Well, first we need to. Okay, I'm looking at the chat. So we all good. Yes, the link was shared, and Delphin is in.
Exactly. So here I'm Elon Officer. As Elon Officer, this is my virtual office with some files. Now I'm going to visit Idrissa to collect informations based on his declaration and also of what I observed. So the name is Idrissa. Idrissa Diouf. And his ID is 6789. He's a male, and the purpose of the loan is not agriculture, is livestock. And then I proceed to the next step, which is the geolocation to link with the exposure he has in his region. So here, for now, as I'm not in Senegal, it will collect where I'm located for now, which is here in Kigali. But generally, it is the place of the client where he's visiting him on the field. And then he'll check the sensitivity based on the activity of the client. So the client is doing aviculture eggs, and also, yeah, for now it is that. And
nothing else.
Now, sorry, he can have three different. Yeah, he can have 2-3 activities. You can collect all of them so that you can check the sensitivity based on the micro climate in his region. Then we have to measure his adaptive capacity based on his practices. And for this case, we say that the client is doing the automated. Sorry, I have to open the matrix. The automatic ventilation and the cooling. So this is his practice-based, the type of solution he's using in his business. And after that, now you have to go to his investment plan. What he
Give me a second. Give me a second. Delphin, can you return to this? So basically, what everything you see is basically here is for chicken production, what are the different climate solutions the customer could be applying? So you see there are a couple more than, no, I think we simplified, yeah? So you basically, you just have a checklist for the loan officers where they verify, does the customer have or does not have a certain climate solution in place? Each climate solution for different threats and for different dimensions comes with a scoring. And via this scoring, you can then automate the calculation of the adaptive capacity. So the more solutions you have, usually the higher your score is. But not each solution has the same weight nor the same score. So depending on which solution the customer has in place, they will have different scores. And obviously what they do not have in place would form part of potential recommendations. That's the whole logic. Obviously here it's a bit simplified, but in general, this logic is then being applied and helps us to understand exposure sensitivity. That's very straightforward, very quickly. Then adaptive capacity, it's yes, no, yes, no, yes, no. That is during the field visit where you do verify and get also these detailed statistics on what is actually being adopted by the customers and what is not being adopted. Main message here, this can take 5-10 minutes to do this part of the credit assessment, and you get the full climate risk profile. Sorry, back to you, Delphin.
Thanks. So, and then here it is the purpose of the loan, which type of climate solution the client is looking for. And here you just select yes, and then you detail the needs. For example, here for the case, the client needed solar panel, and this for this amount, 1,800,000, and then you have a battery. You need battery as well, and for 600,000. And then you want also, I think it was installation, and where also the budget is 6,000. Here is how he'll use his funds. Now, what the loan officer have to proceed now is to check. Sorry, yeah, we are here to check now how this solution will be applied to ensure that these solutions is meeting some standards to be qualified adaptive solution. And here, for example, I mean, here I'll just go to yes, but it will depend of the testimony of the client about what he's going to do. Do you have experience with the climate solution? Yes or no? Are you going to receive or have received the technical assistance advice? Yes or no? What benefit do you expect to obtain? And so on. So by responding this one, then the client, this will help to qualify the solution if really it is at which level. And once all of this done, you can just submit, because we have this case. No, I mean, we have to close some matrix here.
On the first tab, you did not answer. I think you did not answer on the first tab if it's agriculture, and then it does not let you submit. Okay. So
yeah, this one.
This one it is.
Yeah, and then
you.
I can submit. Oh. Such customers already exist. Let me change a little bit his name, maybe, yeah, to make him different because the customer exists already. And then I can submit. Okay. And the case is submitted successfully. And then loan officer can check the scoring and the credit reports. So by there, you can just click to the client. And then go to the reports. Open the report. Here have general information related to the identification of the client, the exposure, the needs of the loan. And then you have the second part where now the report is generated, the scoring related to climate risk, about the exposure, the capacity, adaptive capacity, and generate the climate risk net. And therefore, at this level, you see that the global net climate risk is at 71%. the solution he wanted to finance is a qualified 100%. And down here also, we give indications for those, for loan officers or for the institution if they're not yet familiar about how they can interpret the ratios to appreciate the loan. That is the way it works. And if everything is right, then they can decide to provide the loan, to reject the loan, or to review, to make it under review, to collect additional information. So this is a loan origination solution, simplified for this. But yeah, you can also generate a different type of scoring related to financial, related to other type of scoring, which generally the institutions appreciated to disperse the loan.
Exactly.
I think.
Thank you, Delphin.
Yeah, thank you. Over to you.
Okay, let's close. We are very much over time. What is the main message here? Obviously, you are all invited to buy our solutions, but that is not the message. The message is you can simplify it and standardize it in such a way that you really have the option, and then obviously you can draw this report also as a PDF for your loan file if you need to attach it to the loan file. But the main message is really that you can standardize and simplify the climate risk assessment in a way that it is an additional 5 to 10 minutes per each loan assessment that you're doing, which, depending on what your normal loan process is really a marginal increase of time. But you will get not only the data or the transparency and documentation for funders and investors, but you will get the data. And then obviously, as you build up the data over time, you get much better insights into what are you actually financing, what is the adaptive capacity of your customers, what are adoption rates of specific solutions. And then you can orient, and this is what I did very quickly with the pillars, then you can orient and design your strategy accordingly to make proactive use of this data. That was my session. I see Joanne has a question. Happy to answer. And if not, after 30 minutes, stressing your patience.
Okay, no, it was very interesting and a very enriching presentation. I have two questions. The first question, does your application use web services or API? Can it connect to a census, to census data?
Yes.
Can it connect and feed or receive?
Both.
Both, great. Is it, do you provide a customization? For example, at the end, depending on what type of loan the customer is requesting, can you at the end you can do the credit rating and then determine what type of financial instruments will be used? Not the same for. Oh, great. Yes, very interesting.
So it's a fully no-code platform, meaning we usually do not need to touch code. So we can, even in minutes, we can update. So what we have often is that you have changes, right? So regulation says, hey, you now need to ask for whatever information, and you need to integrate it in all your forms, KYC forms. It takes us 5 minutes to update this, and you log out and you log in, and then it's there. So that is the technological part. Yeah, fully API. If you have concrete use cases you want to discuss, happy to be in touch. Yeah.
Absolutely. One last thing, how tolerant is your application towards internet shortage? Does it do real time or can it do batch?
No, it does batch too. So it's offline. It stores everything, and as soon as you have coverage again, it checks and then it sends off.
Perfect. Yeah. Wonderful. Thank you very much.
It is, and it was a pleasure. Again, invitation to all. If you have follow-up questions, feel free. Benny, you will share all the details, the presentation. Exactly. There you have access to the details on the climate solutions. Everything you have seen in the app, that's for didactic reasons. Yeah, it is very similar to what we, for example, are applying in Mexico, but it is far, far away from institutions which do their entire credit management, loan origination, and loan management with us. That's usually much more extensive and much more complex. So it was for didactic reasons. My final closure words are, you can start with climate risk assessment and adaptation finance at any point in time. It doesn't need to be perfect. It's all about the learning. It's all about getting started. You can build up. I know it's not our nature in many cases, but you can build up these capacities also gradually via initial pilots, focusing on one value chain, on one economic sector. So invitation from our side is really take the leap of faith, start working on the topic. It will be crucial that we have a much better understanding and much more sophisticated loan products and financial and non-financial services over the near future as climate change accelerates. So thank you very much for your lively participation and discussion. And back to you, Benny.
Great. Thank you so much, Christoph and Delphin, for leading us through how to concretely operationalize resilience finance. I think, as you've said, Christoph, I think the term resilience finance tends to be quite abstract and difficult to grasp. And we don't really understand what it means or what the concrete applications would be when we talk about it. But yeah, thanks to your presentation, we got some really very concrete on-the-ground examples and seeing how it can be made operationalizable, understandable for loan officers, and can be done in quite a simple manner, and that it definitely has to be digital in order to be successful. So thank you both very, very much for leading the session today. To everyone, yes, I will be sharing the presentation afterwards, not to worry. Keisha, I did also see your comment. So yes, next week we will be holding a session. No, not next week, my bad. On March 20th, we will be having our next session. So you have 1 week break. Enjoy it. We will be then diving in on Thursday, March 20th at the same time, 10 to 11:30 Eastern, on gender smart tools for resilience finance. So really focusing on how to create financial tools, assessments, evaluations that are really focusing on meeting the needs of women, especially in vulnerable communities. And we will be then hearing from the recap from Buddy Team 6. So that is Keisha and Beverly. I will be sending you an email separately just to make sure that you have everything that you need. So that's that for the next session that we can expect. And in terms of just a couple of reminders to you that maybe you should be thinking about who your end beneficiary or your end client will be for the interview that's necessary for the video production series. So if you can think of an end client that is, or end female client that is directly impacted by the effects of climate change through her business, her community, and or just someone in your community that you know of that would be a suitable fit for the interview. Just to basically start brainstorming on who that would be. If you have any questions, please don't hesitate to reach out, because yeah, I can understand it can be, uncertain about who to choose. So I'm more than happy to help and to support you. And yeah, I guess that will be the close of the session this week. Thank you all so much for your continued engagement and for your questions and for being here. And enjoy the week off, and I will see you all on March 20th.
Thank you.
Thank you.
Everybody.
Thanks, everyone. Goodbye.
Bye-bye.
Thank you.
Ciao.
Bye.